Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis, welcoming you to my podcast Money Talk for Monday the 17th of July. And thank you for making this podcast one of the most listened to financial podcasts in Hong Kong and in Singapore on Apple Podcasts. As well as finding us on Apple, we're also on Google Podcasts, Spotify and Substack. Just search for Peter Lewis's Money Talk. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, China's new home prices fell in June for the first time this year, increasing pressure on policymakers for more stimulus. Home prices had shown signs of stabilisation in the first 5 months of 2023, but new home prices in 70 cities fell 0.1% last month from May. Prices were unchanged from a year earlier, retreating from a 0.1% increase in May. 31 of the 70 cities recorded month-on-month rises in new home prices. That's down from 46 in May. The People's Bank of China hinted Friday at more policy support for the economy, while also urging patience for the recovery to take hold. Deputy Governor Lu Guochang told reporters in Beijing on Friday, "We still have ample policy room to deal with unexpected challenges and changes. We need to be patient and confident in the economy's continued and steady growth." Mr. Lu said China will implement targeted and forceful monetary policy. However, he denied that the country's economy is at risk of deflation after official data last week revealed flat consumer prices and falling exports. Reuters reported Friday that China's financial regulators have invited some of the world's biggest investors to a rare symposium this week, seeking to encourage foreigners to keep investing in the world's second largest economy. The meeting in Beijing, which will take place on Friday, will focus on the current conditions for foreign investment firms in China and the main challenges facing them, according to Reuters, and some of the firms are flying senior executives to China for the talks. Singapore's economy avoided a technical recession in the second quarter, growing 0.7% year-on-year and 0.3% quarter-on-quarter. In the first quarter, Singapore's economy contracted by 0.4% Q-on-Q. Growth was boosted by an acceleration in the services sector to 3% from 1.8% in the first quarter. On today's programme, I'm joined by Alex Wong, Director at Kaiyuan Wong Asset Management, and Christopher Lee, Partner at Farron, Augustine Alexander Investments. And providing a view from mainland China will be Brock Silvers, the CIO at Kaiyuan Capital.
Peter Lewis's Money Talk.
On Wall Street last week, signs of cooling inflation boosted stocks across the board, with the rally broadening from the 7 largest tech companies in the US, which have been responsible for virtually all of the stock market's 2023 gains. More than 140 stocks in the S&P 500 have hit fresh 52-week highs since the end of May. The Dow Industrials and the Nasdaq recorded their best weeks since March, rising 2.3% and 3.3% respectively. The S&P 500 hovered near its highest close since April 2022, gaining 2.4% over the week. US Treasuries paired their weekly rally Friday as strong economic data reinforced the view that it may be too early for the Fed to claim victory over inflation. Data released Friday showed consumer sentiment soared to an almost 2-year high, while short-term price expectations rose. Bonds reacted immediately, with the front end of the US curve bearing the brunt of the selling. The 2-year US yield climbed 14 basis points to 4.77%, leaving it 18 basis points lower over the 5 sessions. The 10-year yield rose 6 basis points to 3.83%, leaving it 24 basis points lower on the week. The dollar steadied on Friday, but had its worst week in 8 months as traders reined in their bets on further interest rate rises from the Fed. The US dollar index fell 2.3% over the past 5 sessions. That's its worst run since November. The yen's 6-day winning streak, based on expectations that the Bank of Japan will soon end its yield curve control policy, came to an end Friday. The yen fell 0.5% to 138.75 against the dollar, but for the week was up 2.4%. The Chinese yuan extended gains into a seventh day, strengthening 0.1% to 7.14 renminbi in Shanghai and 7.15 and 3/4 in offshore markets. The yuan is up 1.5% so far this month. And Hong Kong stocks saw their best week in 6 months as investors bet on fiscal stimulus after data showed the economic rebound faltering. The Hang Seng Index gained 63 points, or 1/3% to 19,414 at the close of Friday trading, bringing the rally last week to 5.7%. That's the most since early January. Chinese tech stocks put in their best weekly performance since December, as Beijing signalled the end of the regulatory crackdown and more support for its private sector. The Hang Seng Tech Index, which tracks 30 of the Chinese tech firms listed in Hong Kong, jumped 8.4% last week. However, the tech index is 60% below its high reached in February 2021. And this morning, there's no trading in Hong Kong, while the storm signal number 8 remains in force, and markets in Japan are closed for a public holiday. You can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our Monday morning guests. We have with us Alex Wong, Director at Alex Kaiyuan Wong Asset Management. Morning to you, Alex.
Hey, morning, Peter.
And also with us Christopher Lee, who is Senior Partner at Farron, Augustine and Alexander Investments. Welcome, Chris.
Hi, good morning, Peter. Good morning, Alex. Hi.
Now, we had some data out on Friday on the state of the housing market in China. New home prices fell in June for the first time this year, and that's increasing pressure on policymakers for more stimulus as the economic recovery falters. Home prices had shown signs of stabilisation in the first 5 months of 2023. But new home prices in 70 cities fell 0.1% last month from May, when they climbed 0.1%. Prices were unchanged from a year earlier, retreating from a 0.1% increase in May. 31 of the 70 cities monitored by MBS recorded month-on-month rises in new home prices, which is down from 46 in May. And prices declined over 0.4% in the secondary market, according to the data. Alex, perhaps you can kick off with your thoughts on this. I mean, obviously the housing market, a key part of China's economy. We heard some new measures to try and stabilise it last week, but it seems to still be on the rocks, doesn't it, this particular sector?
Yeah, I think this particular sector is very hard to rebound because all people actually knew that they could delay their buying decisions because developers are in troubles and then the home prices actually would not go much higher. So I think buyers would be cautious and that could be very hard to turn around. So very likely we would continue to see weakness in this sector. And actually, I think the statistics actually are muted because many developers actually give many gifts away when they sell their flats. So I think this is a little bit distorted figures. The actual figures actually should be even worse.
So you think that actually we may see next month some even worse data on the housing market, even though the PBOC has come out with measures to try and stabilise it, extending basically all the measures that they introduced in November for another year?
I think what they can do is to make it easier for those marginal home buyers. But that is the best thing they can do. And they could not attract much interest from investors and those people who have already owned some properties. Because I think they all don't know that property prices are very difficult to go up. And I think the demand in second-tier cities actually are weak.
Chris, what are your thoughts on the sector? Obviously key to the Chinese economy, isn't it?
Yeah. So I actually think that this is a healthy adjustment. I mean, just building on the point that Alex made earlier, that they are helping the marginal home buyers, right? So we are still having this affordability issue, I think, in mainland China, just like in Hong Kong, that many young urban professionals are not able to buy a decent home to live. And we see that all across the top tier cities as well. So, I mean, in terms of just discouraging the investors from coming in and speculating the property market, that's not something that the policy is trying to encourage, right? So the policy there is really trying to help the average person on the street to get a home if they have a decent job. And again, building on that marginal home buyer argument that Alex made earlier, that I think this is actually not bad for the long term because it really addresses the affordability issue. And we have to help the average person to get a decent home and not helping the investors in speculating.
Do you think Chinese people have basically lost trust and confidence now in the property sector? Because they used to regard it as a safe asset, didn't they? I mean, they just were not used to seeing the prices of their homes go down, or not even used to seeing them not go up, let alone actually go down. Has this really changed now the impact, in people's minds of investing in the property sector, and there's now really a crisis of confidence?
Right. So I take the half full versus half empty approach here, Peter. So while there is weakness in the property sector, but again, the economy should not be just so relying on just one particular sector. There are other sectors that are still very, I think, promising. I mean, the tech sector, as you mentioned earlier, is also improving. And then we're seeing also a bit more domestic consumption. I was just in Shenzhen and also Guangdong over the weekend. And again, I was very impressed by just how efficient and user-friendly all the apps that I have on my mobile phone. You can do everything from ordering a car and also booking a ferry ticket and paying for your meals and, just settling your hotel charges, everything just on your mobile phone via one or two apps. So there's a lot of other good things happening in the Chinese domestic economy. And I'm a big fan of the domestic consumption argument that many people have made over the last few months.
So you're sounding quite optimistic. You're sort of almost in line with what the Deputy Governor of the PBOC said last week, Lugo Chang. He was basically saying, look, we just need to be patient and confident and the economy will continue to steadily grow. You agree with that by the sounds of what you're saying?
I agree with that. Yes, it's a long game here. I mean, there's a bit of a rocky road ahead of us. As you mentioned earlier, youth unemployment rate is still pretty high. And it's just a mismatch of the educational system and the skills that are needed, right, in the economy. But over the long term, I mean, there's going to be more domestic consumption-focused development and not so much of just export-driven and not so much relying on just one particular sector of property.
Alex, are you as confident in the economy going forward? We're obviously going to get a lot of data out later this morning, which we'll talk about in a moment in a bit more detail. But are you sort of in line also with what Chris is saying and what the Deputy Governor of the PBOC is saying?
No, actually, I'm less optimistic. I think it's quite difficult for the Chinese economy to get a sustainable rebound because, first of all, the export sector is very weak. And the domestic consumption actually is weaker than expected. So I think that people need to feel safe in their employment in order to spend more. And also I think that they need a stabilization in the property market. So I think they need to feel good. But in the meantime, it is a bit difficult for them to feel good right now because the two dominant sectors, properties and exports, actually are quite weak. And we probably are seeing a quite high youth unemployment to sustain because probably many young people prefer to get to do the KOL instead of finding a job.
Mm-hmm. And how do you deal with then the property sector? You say that this is weak. I mean, in effect, the funding model for these developers is bust, isn't it? And the government hasn't come up with anything to replace that old funding model. And eventually, these developers, they're just not going to have anything left to sell, and they won't have any revenues either to pay off all these debts. So how do they get out of this? How does the government get them out of it?
I think it will take a very long time for the sector to get back. So right now, probably at best, you can get stabilization in prices, and you could not get much improved demand. And it is very difficult to consolidate as well because many projects actually probably have negative equity after deducting the project finance part. So it's very difficult for them to get bought. So I think that this is a very difficult situation to rebound. So probably we would continue to see the doldrum to continue.
But the Chinese government is putting pressure, isn't it, on the property developers to complete these unfinished properties, these unfinished homes, and get them off to the purchasers.
Yeah, because when the developers get cash flow problem, is quite difficult. So probably they would push banks to do the finance job. So the risk actually is transferred to banks, and you can see actually banking stocks get a very bad performance over the last few weeks.
The government's.
So I don't disagree with what Alex said earlier, but I think one silver lining there again is while the youth unemployment rate is high, almost hitting 20%, but I think we've also seen many young people pursuing non-traditional careers such as the KOL that you mentioned, key opinion leaders. I mean, these are just new sectors and also new areas for further growth. It's just like what we've seen in Hong Kong. I mean, a lot of traditional jobs are disappearing, like the property sector or just the traditional insurance and traditional sort of like careers. But there are new jobs that are going to be created, and there are going to be new roles that we don't even know existed yet. So I remain positive that the entrepreneurial spirit that we've seen in Hong Kong will also be, I think, repeated in different parts of China. Just like we now have a few virtual banks, and we have Equimon, some of these new local startups like the GoGo Van and also Lala Move. These companies, they have created a lot of jobs in the marketplace.
What do you say to Alex's point, though, about the international environment, which is obviously not good, is it, for China's exports? Exports sank 7.5% and imports are down 4.5% in May. So China can't really rely on external sources to bolster growth, can it?
Yeah, because the economy in other parts of the world has slowing down. So first of all, the aggregate demand actually is slowing, and then also China is facing problems that the buyers actually are sourcing elsewhere as well. So I think this is particularly bad for China manufacturing sector.
Chris, what do you think?
I would point to what you mentioned earlier, Peter, that China is inviting investors to this meeting happening this week, Friday in Beijing. And last month, there was also the Greenwich, Economic Forum here in Hong Kong. And so, in fact, I mean, this is not the first time that we're seeing these major economic and also meetings. I mean, I think the vice chairman of the CSRC is going to be speaking to a lot of investors this week, Mr. Fang Xinghai, right? So he's been very, I think, active in the international circle. Previously, also spoke at the World Economic Forum. He had a career working at the World Bank, and also previously, I think, held senior positions at Galaxy Securities. He has a Stanford PhD, and he's been, I think, speaking to many foreign investors. I'm on the board of a U.S. mutual fund investing in Asian stocks, and our chief equity analysts have met with him recently, back in April in Beijing. And many years ago, when I was a young banker at Merrill Lynch, I mean, he came over to San Francisco. So I think there's a lot of these good communications happening between foreign investors and also the regulators in China. So we're definitely on a good path. I mean, constructive engagement is still well and alive, I think.
I mean, it's an unusual meeting, isn't it? It's not the sort of meeting that they normally have. But if you were there, they want to hear from foreign investors about what it would take to get them to carry on investing in the Chinese economy, because obviously they've been pulling a lot of money out. What would you say to them?
Yeah, so I think you describe it as a bit of an unusual meeting. I think the unusual is just the scale. They are doing it at a much bigger scale now, but they have been actually doing many of these smaller scale meetings consistently. Like I mentioned, that the large U.S. mutual fund visit in May and April, and also previously Mr. Fang when he was I think a key executive at the local security firms. He was visiting a lot of those foreign counterparts. So it's just unusual that they're doing it at a bigger scale now. But these things have been actually going on for a long time. And I do think that Mr. Fang is a very good global connector in really helping foreign investors get better and deeper understanding of investing in China.
Alex, if you were at this meeting on Friday in Beijing, where they want to hear what it's going to take to get foreign investors to start investing in the markets again and have more confidence in the markets, and also hear what their issues are, what would you tell them?
I think the key part is to unleash the power of the private enterprises. So this is what they are trying to do right now. But I think the market is still skeptical about whether China would allow those private enterprises to get so much control over the big data. So I think the key part is to get back the investor confidence in the private enterprises in big techs, because we need to see the strength in Alibaba and Tencent back in order to lead the market higher. Actually, China lack mega techs, just like what we have seen in the US, to support the whole market first. So I think the market actually is quite skeptical, because if you look at the car business, actually they are going towards the public sector, the telecom companies, instead of Alibaba. So I think what foreign investors like is to get back the power of the private sectors.
Now, you've said several times on this program over the last 3 or 4 weeks that you want to see an improvement in the government's approach to the private sector to persuade you that, you know, we can have a sustainable market rally. Now, last week, we had Premier Li Qiang meet with senior executives from firms like Alibaba, JD.com. He called them trailblazers of the era. He wants to push them to support the real economy through innovation. And he said the authorities are going to make regulation of these firms more transparent and predictable, reduce compliant costs. And he wants them to look forward and better empower the real economy. Is this enough now from what you've seen to persuade you that maybe it is time to go back into the markets and we can have a sustainable rebound, or do you need to see more?
I think we need to see more, but it is already good enough for us to believe that bottom probably has been hit. So although we may not have too much upward momentum, but I don't think we would see further weakness from here. So I think we are likely to be trapped right now, and people would like to see what the government would do towards the private sector. But in the meantime, I think probably the sentiment has improved quite a lot because of these gestures last week.
Chris, I mean, these are quite significant, aren't they? Because it's really coming from the top. President Xi Jinping seems to be saying at last this regulatory crackdown is over. He wants foreign investment and trade. And then we had Premier Li meeting with these tech firms. Are you taking that now as a positive sign? Is this going to be enough to sort of boost the markets in the short to medium term?
Yes, I do, Peter. And just to answer your question directly that you asked earlier, what foreign investors like to hear, right, is really the further opening up of domestic markets in banking and other sectors that have historically been quite restricted to foreign players and foreign investors. So a lot of that sort of like relaxation domestically would be helpful. And then also, again, I think foreign investors always have been thinking about this whole internationalization of renminbi, topic, right? So this is again, a long game, and it's something that I believe the PBOC and also all the regulators in China are thinking about. But I think the recent rebound in the tech sector is a good start, and then with that, I think we will expect to see more positive development in other sectors.
Okay. Alex, then, so in terms of the markets, I mean, we have seen this big rebound now, haven't we, in tech stocks in Hong Kong over the last week or so. I think it's the best rebound now since December. You say that a floor has been put under the market. How much upside do you think we've got from here, if any?
Actually, right now, not too much. I think this up move actually is accelerated by the short covering part as well. So I think that part actually is more or less done. And probably this week we would have some weakness in the U.S. market, which would drag the sentiment back a little bit. So I think we are likely to see consolidation here. And then we will need to see whether the market would be led up by the tax again. I think the key part is still in the tax. If you want to buy Hong Kong, I think you just buy the back tax, because I think that is the key part. Because if sentiment change, I think that would be led by the changes in the perception towards the private sector. So in the private sector, I think the back tax would be the place to go. So there's not much other parts to select from Hong Kong. So I think we're very likely we would see consolidation here. Probably we have already seen a short-term peak as well. So we are likely to correct back towards 19,000, I think. And then we probably would be stuck within a range for a while before the market decide whether they would trust the change in attitude towards the private sector by the Beijing authorities.
Chris, what are your thoughts on the Hong Kong markets now? We've had a pretty dreadful sort of couple of months, haven't we? But do you think the worst is over?
Building on that tech theme that we've been talking about here, so not just the Asian techs and the Chinese techs have shown good performances. I mean, the so-called Magic 7 tech companies in the U.S. have been doing really well. These are the companies that are basically crossing the $1 trillion market capitalization. I call them the FAAMNNG, right, stocks, which is the Facebook, Amazon, Apple, and Microsoft, Netflix, and NVIDIA and Google. So NVIDIA is the newest kid on the block with very strong performance. And these guys are also having their domestic Chinese maybe similar or equivalent stocks, and they will still be, I think, powering through the recovery. And I think the longer term, as I always say, the longer term game is always to have the sort of like Magic 7 on the east side and also Magic 7 on the west side to really come together and work more collaboratively and constructively together, even though they're competitors, but there's also cooperation upside to gain if the U.S.-China relations improve.
Okay, now let me ask you, this is an important day, obviously, for China's economy. We're going to get a whole dump of data from the National Bureau of Statistics later this morning at around 10 o'clock. We're going to get second quarter GDP, we're going to get unemployment, and we're going to get economic activity data, which will include retail sales, industrial production, and fixed asset investment. Economists are expecting GDP in the second quarter to come in at around about 7.3%. And that compares with 4.5% annualized growth in the first quarter. However, on a quarter-on-quarter basis, the economy is predicted to have risen just 0.5%. Alex, we've got to be a bit careful, haven't we, with this GDP data, because we're comparing it with a year ago when some big cities like Shanghai were in lockdown.
Yeah, of course. And also, we should have enjoyed the benefits of the opening up went in the last quarter as well. So I think the data actually would remain weak, because if you look at the daily set of data, actually they are quite weak. As you said, the trade data are pretty weak. So I think the data would remain weak, and probably people would think policy would need to come out because the data are just too weak. The China economy actually is doing much worse than expected.
And of course, this is going to lead to calls for more stimulus, isn't it? So, but which we've been waiting for now, or investors have been waiting for the last sort of 3 or 4 weeks. But Beijing seems to be reluctant to come up with any sort of big bazooka at the moment, doesn't it?
Yeah, because I think we have seen the impact of last decade. If they use the tools in the old arsenal, I think that would not help much. I think, as I've said, they will need to unleash the power of the private sectors. So I think that is the key part for me. If you lower the weight further or put some much more spending in the infrastructure, actually that will not help.
Chris, what are you expecting from the data?
Yeah, so I mean, as you said, NBS, National Bureau of Statistics, is expecting a 7.3% second quarter GDP growth. So this is really awesome figure, I have to say. And even though we know the COVID years were difficult, but the base is a very large base that we are talking about here. So I again remain optimistic on the outlook. I'll just share one anecdotal sort of like experience. I think Cathay Pacific has been experiencing a very healthy traffic flow again, and they're probably expecting more than 50% of traffic flow just before the COVID-19 period. I just flew back from London to Hong Kong and on Cathay flight, and I have to tell you, this is like almost 100% full. The flight was completely sort of like, kind of back to a pre-COVID-19 level. So I, again, feel good about, the second half of the year, and I would also be wishing all our investors well.
I mean, you're sounding very optimistic. It's nice to hear this. So I suppose, in your view, the mainland doesn't need any more stimulus, does it? Things are chugging along quite nicely. So why try and put the genie back in the bottle, if you like, or try and reinflate the bubble? Just let things go as they are. We don't need stimulus.
Well, I mean, I think stimulus is always helpful. Just like here in Hong Kong, yesterday we got our consumption voucher, and everyone is feeling good about it. So we are not going to say no to anything that would be helpful.
Final word then to you, Alex. I mean, here in Hong Kong, Chris is saying, we're seeing a rebound in inbound arrivals. Cathay Pacific reporting it's back to about 50% now pre-pandemic levels. We've got another $2,000 of consumption vouchers we all got yesterday. How are things looking from Hong Kong's point of view?
I think things in Hong Kong is quite slow. I think tourist arrival actually are good, and you can see crowded places in the malls. But if you look at if you go into those restaurants in the night, I think this is a much worse than expected actually. For last week, I actually encountered very quiet restaurants a few times in night in Hong Kong. I think the general spending towards the higher in the higher end actually is quite weak right now. So probably we have some polarized impact. Probably people are going towards a few favor sports only. So anyway, I think in Hong Kong sentiment is much weaker because we had a very slow equity market. People in the finance industry actually are feeling quite bad because there's basically no big IPOs. Trading is extremely slow, and I think this probably has not changed much, and it takes time to get the sentiment back. So very likely we are led by the weakness in the finance sector and also the public sector. So I think the spending overall may not be that good.
Okay, well, thank you both very much. Have a great week and stay safe in the typhoon this morning. Typhoon signal number 8 is in force here in Hong Kong. That was Alex Wong, Director of Alex K.Y. Wong Asset Management, and Christopher Lee, who is Senior Partner at Farron, Augustine and Alexander Investments.
Peter Lewis's Money Talk.
I'm joined now by Brock Silvers, who is Chief Investment Officer at Kaiyuan Capital. Morning, Brock.
Good morning.
Let me get your thoughts, first of all, on this latest data that came out over the weekend on the state of the property market. China's new home prices fell in June for the first time this year. New home prices in 70 cities fell 0.1% last month from May. Prices were unchanged from a year earlier. And in the secondary market, prices were down 0.4%. Doesn't seem to be much sign of any recovery, really, in the property market, does there?
No, look, there isn't. We've all got to understand the fundamental basis of China's real estate model has changed from pre-COVID times to now. And the days of kind of unconstrained credit to developers buying at inflated auctions and selling to manic retail speculators, that's all gone. And at this point, developers are generally insolvent. Now, the government seems to be focused on a different set of issues. A series of 5 or 10 basis point rate cuts just isn't the answer. It's not a liquidity issue. Toying with mortgages or bans on second home purchases, again, that's not going to resolve the sector's problems. The entire sector needs to be rethought, reorganized, and recapitalized. And we don't seem to be ready to acknowledge that yet.
So if this funding model is basically broken, or more than broken, it's bust, isn't it? This old funding model for the Chinese developers. They're going to get to the point soon where they'll have nothing left to sell, no revenues. What is going to replace that old funding model? Because it seems unless the government does come up with something to replace it, there's no chance of the property sector rebounding.
You would think that the government is busy trying to craft an answer to that question. And it becomes a tricky one because you also have loads and loads of people who have already invested in uncompleted apartments, and that becomes a tricky social issue as well. But the problem has to be dealt with, and at some point we are going to get a reorganization of the real estate sector. And from my perspective, the writing's on the wall, so the sooner the better.
Have Chinese people, have they lost confidence altogether in the housing market now? Because this was always seen as a safe asset, wasn't it? You put your money in housing and you were guaranteed it was going to go up. Has Chinese people's perceptions of the property market and the safety and security of the value of their home changed?
They certainly have, and they look at this system and they're no longer willing to play the game. And that's why you don't see a tremendous rebound in the demand for new flats by retail investors. And again, it's not an issue that somehow rates are a bit too high, or if I could just get the okay on that second mortgage, I'd be game. That's just not going to happen.
Well, we got a lot of data coming out today from China. We're going to get second quarter GDP, we're going to get important unemployment data, and we're going to get a whole load of economic activity data, retail sales, industrial production, and fixed asset investment. It looks like, Brock, on the surface, this second quarter GDP number is going to sound quite good. People are expecting 7.3% growth, but then if you compare with the first quarter, looks like we're only going to get about 0.5% growth. And of course, we're comparing this with a year ago when China was in lockdown.
Yeah, that's right. Look, buckle up. We are expecting a blizzard of information. Now, almost everyone expects sort of relatively poor June results. And I think there's little question the recovery has disappointed and now probably fizzled. A couple of key things. Exports are cratering in a way China hasn't experienced in generations. Producer prices in June, we know, plummeted at the fastest rate in almost a decade. Now, despite that, brace yourself also for an onslaught of kind of sycophantic insistence that China's in great shape. And a lot of people are going to tout a 7% plus claim. I'm very skeptical. I think we're basically flat, which intuitively seems more realistic. Ask yourself this. If we were honestly growing at 7.3%, there'd be no need for stimulus. No one would care about stimulus. We'd be self-stimulating. In reality, exports, retail demand, industrial production, all quite weak, while the government is deciding how hard to chase away foreign investment. None of this sounds like a very good combination, and I think the reaction to the blizzard of data today will probably not be positive in the end.
I mean, the authorities seem to be going all out to try and talk the economy up, don't they? We had the PBOC last week saying they're going to take sort of forceful and targeted, they're going to implement targeted and forceful monetary policy. But are we hearing anything new from what's just been said the last few weeks, or is this just a regurgitation of the same thing, just using different words?
Look, this is a pet peeve of mine. I think that the PBOC and other authorities are intentionally trying to manipulate market sentiment because there's not yet a plan, or at least one that can be announced or enacted. So we get authorities crowing about how we're going to be super duper supportive. This time I really, really mean it. But this sort of misdirection does have an impact on markets. We've seen that. It won't be a long-lasting impact, but it does have an impact. Now, what we can say right now is that it's not about rate cuts. That's not going to solve the problem. A cut in triple R speaks to increased liquidity when liquidity is already ample. What it doesn't speak to is the 35% of GDP that was lost when the real estate sector collapsed, or the trillions of dollars that were lost to regulatory clampdown. So what we get is, in the absence of a declared policy, we see Liu Guoqiang or Li Qiang reassuring us publicly, which honestly does nothing to make me want to write a check.
So you don't think, because people got quite excited last week when Li Qiang met with, the senior executives of Alibaba, JD.com, ByteDance. He called them, these companies, the trailblazers of the era, although he didn't say that we've just wiped off, over $1 trillion of value in some of these companies. But nevertheless, do you think that maybe they realise that they've gone too far and, some of the problems of the economy are self-inflicted and they've got to try and rectify that?
Well, I do think that there's a recognition that we've gone too far, but the question is, have we gone too far or have we gone too far for the moment? And that we just can't tell right now. For the record, I just don't understand this kind of celebratory reaction to what we perceive as the end of the regulatory clampdown. It was a surprise long-term process that we couldn't question or appeal, but it cost investors trillions of dollars. And some of those losses seem terribly inappropriate and unfair. So now some subset of investors thinks we should just ignore that precedent and, accept kind of a silent wink and a nod from bureaucrats to indicate there's been a secret resolution to an undefined problem. Well, I don't know. Once the economy has stabilized, are regulators going to return to their former priorities? I don't know. You don't know. No one knows. If the plan is for me to time my entry now and then time the exit before the regulators reawaken, that seems like a very poor plan.
So it sounds like you're not impressed with this market rally that we saw last week, particularly in the tech index. It was up 5.7% last week. That's the most since January. It added almost $200 billion to the value of Hong Kong's stock market. But from what you're saying, you think investors are being a bit delusional here.
I'd bet against that rally because right now I see no reason to think the water's safe. We have no idea if those same sharks are swimming in the same area. Now, for fast-moving flow traders, for experts who are used to getting in quickly in response to local news, China tech may be very ripe right now. Valuations from that perspective may look good. But for most investors, particularly value guys, buy and hold guys, the allocation should probably remain zero. What discount rate can I use to account for a potential government wipeout that could come at any time? So I also think we have to beware of recommendations from those whose bonuses are dependent upon our acquiescence.
So what would it take to get you back into the market? You say the risk allocation to China should be zero. What would make you start to rethink that stance?
China has to address a couple of things. They have to give reassurance on fundamental investability. Is there systemic stability in such a way that Western investors can accept the premise of China? And in addition to investability, we've got to discuss growth. The Chinese model, again, just dropped kind of a third of their GDP growth when the real estate sector imploded, and I don't see that coming back. Exports are down rapidly in a global geopolitical environment that doesn't seem favorable for increased Chinese exports right now. The tech war rages, and we all kind of expect that to get worse before it gets better. So the twin issues are convince me that it's investable, and then show me where the replacement growth is going to come from. And right now, we're not even discussing those issues. We're busy getting sort of bland assurances of support or this invitation to the global investor meeting, which is kind of a sales job. And let me say that my email must not be working because I didn't receive my invitation as of yet.
Well, this is an odd meeting, isn't it? Well, maybe not odd. It's a rare meeting, isn't it? You don't normally see this where, the officials, Beijing is inviting foreign investors specifically to tell them why they don't want to invest at the moment and what it is that they've got to do. So presumably, by the very fact that they're doing this, they are concerned. Do you think there's much chance that we might get an answer to your questions at this meeting on Friday?
No. Look, I think if they had an answer, there would be a policy announcement rather than a meeting announcement. I think that the meeting has to occur is itself probably bad news. It says to me that the sales job continues, as if a lunch with Chinese economic bigwigs is all I need to convince me to start investing again. Whereas I say we need policy clarity, particularly with investability and growth. And this meeting seems to signal the opposite. I don't think we're at the point where I can get the reassurances that I need. But maybe that's why my invitation was lost in the mail.
It could be, but maybe it's also investors seem to be worried that despite all this talk, something else may come along. There may be a new sector that comes under regulatory scrutiny for some reason, or just some new policy out of Beijing, which have a habit of coming up also almost without warning, don't they? Is that part of the problem, the uncertainty at the moment of what policy might happen next?
It absolutely is. And look, foreign investors by and large want to comply with Chinese law and regulation. The problem is we often don't know how to do that. And you don't want to be caught on the wrong side of that equation and have to explain to an ex-China investment committee why you've gone so terribly wrong this year.
I get it. I understand. Okay, well, hopefully your invitation will turn up, Brock, and I'd be interested to hear what you say to them.
Crossed.
What they say to you. Thanks very much. It's always a pleasure talking to you. That's Brock Silvers, who is Chief Investment Officer at Kaiyuan Capital. Thank you very much for listening to Money Talk this morning. You can find more details about some of the topics I've been talking about today, along with information on other headlines and market moves on my daily newsletter. Take a look at peterlewismoneytalk.substack.com. I'll be back with another show tomorrow. Joining me then will be Asian fund management industry consultant Stuart Aldcroft, David Roche, President and Global Strategist at Independent Strategy, and our US economics correspondent, writer and broadcaster Barry Wood. See you tomorrow.
Money Talk